Imagine a struggling biotech company with over $141 million in losses suddenly becoming worth nearly $500 million. This isn't science fiction. It's the new reality of corporate crypto treasuries, and it's reshaping how companies think about their balance sheets. Meet ETH Zilla, formerly 180 Life Sciences, a biotech firm that was down 99% before making one of the boldest pivots in corporate history. Just weeks after rebranding and adopting Ethereum as their core strategy, they've approved a $250 million stock buyback program. Here's what happened. ETH Zilla acquired 102,237 ETH tokens at an average price of $3,948.72 each. They spent just over $403 million, and at today's prices, those holdings are worth approximately $489 million. But ETH isn't alone in this digital gold rush. Companies like Bitmine Immersion Technologies, the Ether Machine, SharpLink Gaming, and BitDigital are all making strategic Ether acquisitions. In fact, Ether treasuries have climbed to $13 billion as more corporations embrace this strategy. Why is this happening now? Traditional corporate treasuries
Earn minimal returns in low-yield environments. Meanwhile, Ethereum offers something that traditional assets cannot: staking yields and DeFi opportunities. As Cadden Stadelman from Komodo Platform explains, spot ETFs cannot legally offer staking and DeFi. Ethereum treasury firms offer higher yields.
The numbers are staggering. Roughly 3.4% of Ethereum's total supply is now held by corporate treasury entities. That's unprecedented concentration for any major cryptocurrency, creating both opportunities and systemic risks. But here's the critical warning. This strategy comes with significant leverage and concentration risks. Mike Foy from Amina Bank cautions that it's too early to tell whether crypto treasury strategies are sustainable long-term. Companies borrowing heavily to accumulate crypto could face devastating consequences during the next bear market. Think about it. If these companies acquired their holdings through loans, convertible notes, or equity dilution, falling ETH prices could trigger forced liquidations. This creates a domino effect that could cascade through the entire Ethereum ecosystem. The parallel to corporate gold adoption is striking, but with a crucial difference: volatility. While companies have held gold as a treasury asset for decades, Ethereum's price swings are exponentially more dramatic. A company that leverages up during a bull market might not survive the next crypto winter. Anthony DiMartino from Centauro Research points out that Ethereum is the most exposed of all digital assets to this corporate treasury trend. This concentration creates both tremendous upside potential and systemic downside risk. So, what does this mean for investors and the broader market? We're witnessing the birth of a new asset class: corporate crypto treasury plays. These companies offer exposure to Ethereum's upside while theoretically providing the stability of public company governance. However, investors must distinguish between companies pursuing crypto for legitimate strategic reasons versus short-term share price manipulation. As Foy warns, if purchases seem strange or out of the ordinary, it might be a red flag for speculative behavior rather than sound treasury management. The bottom line: corporate crypto treasuries represent either the next evolution of corporate finance or a dangerous concentration of risk. Companies like ETH Zilla have shown that betting on Ethereum can transform struggling businesses overnight. But the leverage risks and market concentration could also create systemic vulnerabilities that didn't exist before. The question isn't whether more companies will follow this path. They already are. The real question is whether this trend will strengthen the crypto ecosystem or become its Achilles heel when the next bear market arrives. What's your take on corporate crypto treasuries? Financial innovation or systemic risk waiting to happen?